Howdy, Jacob here. Today we're looking at Eagle Materials in the construction materials industry with 8.6 billion market cap on 9.5 billion enterprise value. So we are seeing a little bit of debt here, but outside of 2019 minus 5% revenue growth, the lowest of the last 10 years has been 5.9%. So we're seeing a fantastically growth company with good returns on invested capital. There were some down years, but we're averaging for sure double digits, which is absolutely above their weighted average cost of capital. So that's great. They're definitely creating business here. Company was founded in 1963. Very interesting that they have a high return on invested capital for what appears to be a capital-intensive business based on description. Their income statement shows a good decline of shares. Obviously, you want them to be buying back shares cheap, which hopefully they're doing. Good increase in net income, and their net income increase is greater than their revenue, so they're becoming more efficient with all their dollars invested. But the balance sheet is where it gets a little sticky. We see about 1.1 billion in long-term and short-term debt with just 15 million cash on hand. But let's see what that is in relation to their cash flow. So cash flow on a 5-year average basis, probably maybe $350 million. And so that 1.1 billion is about 3 years, a little less than 3 years of their 5-year average free cash flow. That's not concerning, but you do want a company to have a little bit of cash reserves on hand just in case. You never really know. There's always business factors that the worst case occurs, then it's always good to have cash. Just like an individual, you want to have some cash on hand in case you need to weather a terrible storm and the worst case comes out for you. Obviously, you'll be giving up a little bit of return on both for the person as well as the company. You're giving up a little bit of return, but you're going to be able to withstand those terrible situations. And with just 15 million on hand and that much debt, I'm a little bit concerned, but not in the fact that they are producing very positive free cash flow. And so you're just going to want the company to slowly start paying down that debt, some of that higher interest bearing debt, some of the closer maturing debt. You just want to pay down a little bit of that with the excess cash flow that you're not putting towards making acquisitions or repurchasing shares or paying a dividend. So back to the cash flow statement. The dividend of 36 million in aggregate is about just over, it's 10 to 15% payout for their 5-year average free cash flow. They are paying down a lot of shares, repurchasing a lot of shares, and they're making quite a bit of acquisitions here, I would say. At least in the last 5 years, a little bit of devastation, but overall, pretty large increase in expenditures for acquisitions. And so I'd say use of cash flow is 10 to 15% dividends, maybe 30% acquisitions, and then the rest in stock repurchases. Okay, so let's start making some assumptions with this. I would say that growth is just crazy growth. Are they going to be able to keep that up? I don't know. Let's do 7% revenue growth, 18. Let's do 17p in price free cash flow based on what is growth going to look like in 7 years. Maybe not as great, but still above the market. And then as for margins, they've been going up, but I wonder how sustainable that is. Let's see. Yeah, they've been going way up. So let's do. It's always funny when their operating margin is higher than their gross margin used to be. That's great. Okay, so I do love that free cash flow margin is way higher than earnings margin. So let's do 20 and 22%, saying that they're able to keep that inflated margin up, maybe even increase it a little bit. And then on the share change side, they have been using a lot of money for share repurchases. Let's see, 8.5 billion. 8.5. If they were to buy back 2% of shares, that's 170 million. They have about 350. Okay, let's do 2.5. So that's going to have them have a payout ratio similar to maybe 50%, 60%, and then the rest they can use for acquisitions and the little dividend that they have. The dividend they can afford, but it doesn't look like they're really increasing it much, so I'll probably just stick with how it is. And we get to a final price that needs to fall just 33% before you get a 15% return with these assumptions. I'd say that this is a good company. It's definitely, I wouldn't say it's the best company I've seen that I'm instantly saying I absolutely need to own it, but it does look like a great company. And for construction materials industry, in the construction materials industry, having these types of returns on invested capital has got to be a good sign. So hopefully you enjoyed the video and have a fantastic rest of your day. Thank you.